silver is the fuse, if you will, to gold's financial bomb. Because when gold blows, when gold goes into failure to deliver, then you've got pretty much confidence across the world is going to collapse. Because, I mean, think about it. What's the value of a contract that cannot perform? The value is zero. So silver is such a small market. I think at current prices, you're looking at maybe 30 billion total production worldwide for a year. It's just such a small market in relation to gold. And you can't have silver exploding. You couldn't have $200 silver, in the short term. You couldn't have $200 silver and $3,500 gold. I mean, the ratio would completely collapse, and that would lead to a failure to deliver.
Silver is like the trigger for gold's financial explosion. If gold enters a failure to deliver scenario where promised gold can't be provided, it would destroy global confidence in financial contracts. Analysts at NASDAQ and market watchers, such as Sprott and Oliver, point to a likely correction. Silver could quickly rally through the $50 plus zone if technical momentum and demand continue. Some even suggest moves towards $60 to $70 an ounce before a pause. And silver hitting $200 an ounce is plausible if gold reaches just $3,500 an ounce. Though this is more improbable in the short term, it's mathematically consistent if ratios fully normalize. Bill Holter, a seasoned financial commentator, precious metals advocate, and partner at jsmindset.com, explains that foreign central banks are increasingly demanding their gold back from the U.S. Federal Reserve, driven by rising distrust, especially after events like the U.S. seizing Russia's $300 billion in reserves and giving the interest to Ukraine. According to the recent World Gold Council survey, nearly 95% of central banks plan to increase their gold holdings over the coming year, while 3/4 expect U.S. dollar reserves to decline, highlighting a broad shift toward financial security and away from dollar dependence. Countries like Germany and Italy, which hold over $245 billion worth of gold, much of which is stored at the New York Fed, are facing growing internal pressure to repatriate that gold. Politicians from multiple parties argue that political risks and recent U.S. leadership turbulence justify repatriation. However, central banks publicly still trust the New York Fed's custodianship. In Serbia, the central bank announced it will store nearly all its gold domestically, becoming one of the first European countries to repatriate reserves for greater control and crisis resilience. Overall, the share of global gold reserves not stored at the New York Fed or the Bank of England has risen to 78% in 2024, compared with 51% in 1972. Nations are prioritizing sovereign custody over global vaulting. Central bank gold purchases remain elevated, on track for approximately 1,000 tons in 2025, the fourth straight year of massive accumulation, driven by strategic hedging, inflation, and geopolitical tensions. As we begin the video, remember to subscribe and press the bell icon to stay up to date. We value your feedback, so please leave a comment and give us a thumbs up if you liked the article.
The deliveries were made. It was said back then that it was because of the tariffs. I don't really. I think gold was being onshored or brought back. Another thing that's going on that almost no one's talking about is that you have foreign central banks that are demanding gold back from the Fed. And if you remember 10 years, 12 years ago, Germany requested, 320 tons or something like that. And it took them over 3 years to do it. And at the time, they were saying that, it's too much weight. It can't be done. The logistics just can't be done. Well, we just saw that it can be done. And 320 tons, you could do it with 4 plane loads. With Boeing 747 cargo planes. They can carry 95 tons each.
What if the U.S. government can't deliver the requested gold back?
That completely breaks all trust in the United States. Would you ever do business again? If you were a foreigner, would you ever do business again with
Right.
the United States. And they've already come pretty close to that by sequestering Russia's 300 billion in forex reserves in treasuries. And now they're taking the interest from that 300 billion, and they've been giving it to Ukraine to fight Russia. I mean, so basically Ukraine's fighting Russia with Russian monies. Just to get back to what I was just talking about, the Russian reserves. You go back and you look at a chart of gold, and you can see to the day, it was October of 2023, I think, when gold lifted off and came out of the range of the, 1,700 to 2,200 or thereabouts. But the following day after that was announced that those reserves or those treasuries had been sequestered, gold all of a sudden kicked into, it started looking like a tractor in first gear going higher. And that is a function of trust.
Is there still? Go ahead.
Foreign central banks just looked at that and said, hey, wait a minute, if they can do that to Russia, they can do that to us. We'd rather hold something that we actually hold, we know cannot go bankrupt, we know cannot be diluted. It's God's money. But I think we're going to go through at least one, maybe two resets before we get to the final reset, the Mother Nature reset. The first reset, I mean, there's no doubt in my mind that they're going to try to do some type of central bank digital currency or whatever, stable coin. It's still going to be fiat. And I don't think that that's going to last much more than, I don't know, maybe 6 months. Could be less than that. Could be a little longer than that. But I think we're going to go through a reset, and they will mark the price of gold up on that reset. But we're still going to have a fiat currency. And whatever the end result, as far as what the world reserve currency is going to be, it will be tethered somehow, ratio backed or whatever, to gold. There's no way that the world is going to accept the situation we're in now again. Well, you would see a loss of confidence because if the Federal Reserve cuts rates, say they cut it 1%, 2%, and rates don't go down or go down very little, or in my opinion, ultimately rates are going to go higher rather than lower, that would break confidence. Now, in the real world, what does that mean? You're already looking at super soft real estate market, housing market across the country. Commercial real estate is already in the middle of a crash. Higher interest rates will smoke the real estate markets. Higher interest rates make it harder, more difficult to carry derivatives. And the world is awash. It's flooded with derivatives, and those derivatives are what price assets. You'll see derivatives begin to default, and then you get a cascade. And once derivatives default, you're talking about over $2 quadrillion worth of derivatives, which is way, way, way more than the value. It's probably double the value of every asset on the planet. So it'll be a paper bonfire.
When they really do lose control of the paper markets, whether it be in gold, whether it be in silver, whether it be through a failure of delivery or something else, what are the chances that it spreads like a wildfire to other paper contracts like oil or natural gas or anything?
100%. 100% guaranteed. I mean, you cannot have a sector of derivatives fail and other sectors not fail. And the reason being, it's one big, gigantic financial orgy where everybody's connected to everyone else. So if you get one entity that's infected, the entire system's infected. And understand that the problem with the derivatives chain, the way it's set up, is that if you have a contract between two entities and one entity wins, I mean, it's a zero-sum game. So one entity wins, the other entity loses. But if the loser loses so big that they can't pay, then the winner doesn't get paid.
Yeah.
Then whoever the winner is, whoever they're doing business with, they're going to say, hey, wait a minute, they got this big loss on their books. I'm not sure they're stable. So it spreads like that. And of course, the loser, they've gone bankrupt. So anybody who's doing business with them already, they become an immediate loser because the other side of the trade can't perform on that contract.
Bill Holter highlights that the push for a global central bank digital currency, CBDC, is likely to come through engineered crises, market crashes, banking failures, and the collapse of pensions and insurance firms, which would leave the public desperate for stability. While major global institutions, such as the IMF and BIS, are vocally promoting CBDCs, significant risks remain. For example, the European Central Bank warns that dollar-backed stablecoins could undermine monetary control and destabilize policy frameworks if they are widely adopted. Analysts draw parallels between today's crypto regulation, notably the Genius Act, and past deregulatory spurts like the 2000 Commodity Futures Modernization Act, which preceded the 2008 financial crisis. These engineers of market liberalization, operating under the guise of safe innovation, risk triggering systemic instability. Central banks and financial scholars, IMF, BIS, warn that CBDCs could fuel faster digital bank runs. During turbulence, deposits may rapidly shift to central bank guaranteed digital currency, draining the commercial banking system and amplifying liquidity stress. Despite rate cuts, market interest rates haven't fallen and have risen slightly, indicating a loss of confidence. Foreign central banks, once major buyers of U.S. treasuries, are now shifting away, either selling them or choosing not to buy more, in favor of gold, which cannot be defaulted on or diluted. Countries like Japan and China have drastically reduced their treasury purchases, with China's holdings now at levels not seen in over a decade. This trend shows a growing global preference for gold over U.S. debt as trust in the dollar and U.S. fiscal stability declines. Now, let's recall the interview.
The ultimate goal is to get the entire earth under a central bank digital currency. Now, how do you do that? You couldn't bring that out today because the vast majority would say, no, I don't want to do that. But if you destroy markets, and remember, when markets get destroyed, you're talking about banks, brokers, insurance companies, etc., going under. People, the great taking is going to happen. And when that does happen, people are going to beg governments around the world for a central bank digital currency and universal basic income that will, save the individuals. The only problem with a central bank digital currency is that they can shut people down anytime they want. You and I, we do an interview like this after a central bank digital currency. Before we got off the call, you'd have nothing. Your account would be frozen. My account would be frozen. And all you got to do is look at the Canadian truckers to know the mindset as far as wanting to shut people off that speak ill of the official policy. Okay, so gold was $1,700 2 years ago. Now it's $3,400, double. Any asset that is the same price that it was at the end of 2023 has lost 50% of its value versus gold. Mm-hmm. And gold is the measuring stick. It's not the dollar. It's not the yen. It's not the euro, the pound, whatever. The measuring stick is gold. And that's why when people ask me, are we going to have inflation or deflation? Well, we're going to have inflation of the things you need, food, gas, etc., and deflation of the things you have. And the deflation of the things you have, not necessarily in dollars. You could see an asset, you could see a piece of property double in value and gold go up 4 times. And that thing that doubled in value has lost 50% of its purchasing power versus gold in that time. So gold is the measuring stick. Yeah, we already have, if you want to call it insider buying. What if central bank been doing for the last 2 years since the sequestering of the Russian treasuries. Central banks all over the world have been buying gold. That's about as inside as you can get.
Right. Any other signals that you look for when it comes to gold and silver?
Because I believe that this has to be a credit/currency event. I think if all of a sudden you started seeing wild volatility in currencies, if you started seeing bigger volatility in or on the U.S. Treasury curve, I mean, this is going to be a credit/currency event. And if you start seeing, wild gyrations, or not even wild gyrations, just a movement upward. If you see rates go through 450 on the 10-year Treasury and you get a 5 handle or over a 5 handle, I don't think markets can handle that. And I think that would be a signal to foreigners that the game's over.
I see. Well, Bill, it's been a pleasure having you on, my friend. Anything else you want to talk about that we didn't get into before we close things out here?
Well, we could probably go for 2 or 3 hours or more, but
Floor is yours.
I think what we did today was we covered really the absolute nuts and bolts of the problem. I mean, the problem is too much debt. There's very little collateral worldwide that's left that's unencumbered. It goes back to Richard Russell's inflate or die. And the question is, can they reflate? Can they? Of course they can reflate, but can they reflate without destroying the value of the currency? And I don't think so. Well, actually, from the day that they cut rates to where we are today, we're up almost a full percentage point. If you look at the tail on that chart, that green line, that's where they cut rates. So we're actually not substantially higher, but we are higher rates. Market rates did not come down.
And what's interesting is that if you look at when we stopped cutting rates, which was back here in January, we actually were on an upswing higher on the 10-year, right? So you go from here to there. And then when they stopped cutting rates is when it started moving sideways.
Right. Yeah, that's my point. I'm not sure. I mean, we'll see what happens, but I suspect that if they cut rates again, look, to begin with, you've already got foreigners dumping treasuries. There was a pretty good article done by, it wasn't Vince Lancy. I forget who did it 2 or 3 days ago, talking about gold is replacing treasuries on the balance sheets and in the minds of central banks, foreign central banks. In other words, they're opting to take either they're selling treasuries and buying gold, or instead of buying treasuries, they're buying gold. So gold is becoming a bigger and bigger, more important part of central bank balance sheets. And the reason being, it cannot be diluted, it can't default. And we know that that's not the case with treasuries.
What happens when more foreigners dump the U.S. debt? Have they been dumping in significant numbers? I mean, but the vast majority of the debt is still owned by foreigners, isn't it?
Just look. I mean, look at Japan has not bought anything in the last few years, and if you look at China's holdings are back to where they were 10 or 11 years ago.
We're witnessing a historic shift in global finance. Silver is quickly emerging as a pressure valve in the gold market, indicating deeper concerns about the stability of fiat and debt-based institutions. Central banks are hoarding gold and repatriating reserves, fueled by geopolitical upheavals, inflation, and the fear of asset confiscation, laying the groundwork for a breach of traditional financial standards. Meanwhile, the emergence of CBDCs due to crisis-driven narratives portends a future conflict between centralized control and sovereign hard asset preservation. Would a mass repatriation of gold and a concurrent surge in silver prices lead to a fundamental overhaul of the global monetary system? If fabricated economic crises are used to push for the introduction of CBDCs, will public opposition to them grow? Please share your thoughts in the comments section below. We'd be delighted to hear them. Don't forget to subscribe for more videos and give this one a thumbs up if you found it helpful. We appreciate you sharing in our adventure.